Okay, we'll begin in a few minutes to give a couple more people some time to log in. We'll start in a couple seconds. Okay, we'll start the webinar. Thank you for joining. Today's webinar is the mystery of the debt ratio, which is basically to give you a better understanding of the process of getting yourself pre-approved, the calculation and what's involved in the underwriting. I see we've got some old faces from previous ones as well as new ones. Welcome. And why don't we get this started here for you. Okay. There we go. A little bit about myself. I'm Jim Campanella, the sales manager of your mortgage guys at Cross Country Mortgage. I've been in the business for approximately 35 years from all aspects of the business. All right, so a little bit about the mortgage terms, which will help you understand about the process now. All right, debt to ratio income is really what we're going to be talking about here, the debt ratio. What the debt to ratio income is taking into account your gross income on a monthly basis and dividing it into the expenses that you have monthly. And the expenses would be your mortgage payment as well as your monthly debts that show up on your credit report. So not necessarily your monthly debts like utility bills, but your monthly debts like car payments, student loans, so on and so forth. And we'll go back to that a lot more because that's really what the topic is. Loan to value ratio, or LTV, is taking into account what the home is worth versus the amount you're borrowing. So make the number simple. On a $100,000 purchase, if you borrow $95,000, that's 95%. Your PITI, or according to this PITI, but we just call it PITI, stands for your principal, interest, tax, and insurance. And what that is again, your mortgage payment. We take into account a portion that goes to principal, a portion that goes to pay your interest, and then we escrow for your taxes and insurance so that when they're due, there's enough money in the account to pay for that. Okay, so the monthly house payment is your PITI. Again, it's your principal and interest, taxes, and insurance. So right now, a simple calculation for you to know is based on today's rates, per $10,000 you borrow, it's $50.67 for a 30-year loan, or $73.97 for a 15-year loan. So if you want to borrow $100,000, the principal and interest is $506.70. And that's a simple calculation, but it helps you understand, what type of houses you can afford. Okay, and again, breaking down the components of your PITI is principal, that's repaying of your debt. Interest, that's where the banks make money, is the amount of interest we charge on there, and the calculation for that. Your taxes and your insurance. Insurance can be your homeowner's insurance, your homeowner's association dues, your private mortgage insurance, all the insurances that are paid monthly. Your taxes are your annual taxes divided by 12, and we divide by 12 simply because there's 12 months in a year. So if your taxes are $2,400 a year, divided by 12 is $200 a month. So that's what we would collect for your taxes. Now, you're always ultimately responsible for your taxes. So should the taxes go up and we collected $2,400, but your taxes were $25, that extra $100 you would actually owe. But consider your escrows like a savings account. We put aside the money so that we can pay your taxes and insurance. Okay, so basically how debt ratio is calculated is we take your proposed monthly payment for your house, your credit card minimum payments that show up on your credit report, your personal loans and student loans, your auto loans, any alimony, child support, or any type of payments like that. That comes up for your total debt. We divide that by your gross income. So again, if your total debt is $250 per month and you make $1,000, you're at a 25% debt ratio. The reason we've got to keep that in mind is depending on what type of loan program we do, whether it be conventional, FHA, VA, so on and so forth, we have to keep you under certain debt ratios. So as an example, with FHA, the guideline is 45%. You can go up to 50, in some situations, 55% of your income. And this is based off your gross income. So you got to keep that in mind, because if the bank comes back and says, hey, congratulations, you're qualified, that may not necessarily mean that you're comfortable at that number. And the reason for that is, let's use my example again. Let's say your house payment's $500 a month, you make $1,000 a month, you're at a 50% debt ratio. But after taxes and everything else, you're not coming home with $1,000. You're coming home with maybe like $780, but your house payment's $500. So that doesn't leave a lot of room for you to live, for utilities and food and everything else. So although what the bank qualifies you for is important, you also have to keep in mind what that payment is and what your comfort level is, what you've budgeted for yourself. And that's, post 2008, since the recession, more and more customers, I have to say, are taking that into account. Just because we tell them they're approved for $300,000, they come back and say, no, we don't like that payment. Let's buy something for $250 or $200 or whatever else. And that's good to see, because that means that people are watching their budget, where prior to that, the recession, maybe people weren't watching it as close, and that's what put it, in part, what put us in this situation. Okay, I do have a simple method. I can, certainly, if you wish, contact me, and I can provide you this worksheet I've created. You fill in the numbers, and it calculates your debt ratio for you. Obviously, that's what we're going to be doing as the lender anyway. But if you'd like to, get a feel for what's going on and get a feel for what you can afford, this spreadsheet I've created certainly is available, and just reach out to me, and I'd be happy to share it with you. Some tools that are available to you, various calculators and so on. If you go to my website, campyisyourmortgageguy.com, and click on the Resource Center, you can find these type of calculators available to you and free to use. You can just go in there and type in, various houses you find and see what the rough idea, what the payment would be. And that's a useful tool, again, as you're out shopping for houses, to get an idea of what you can afford. Okay, then, as I've mentioned in previous webinars, it's important because the processing staff, the people we work with, has made it clear to me that we have to make sure we tell everybody that your home buying do not list. And what that basically is do not make any large purchases using your credit cards. Do not open any new credit cards or installment loans, because that'll affect, now you understand, your debt ratio. Do not apply for a new credit that would cause inquiries on your credit report, because then we're going to ask you what that inquiry was, and if it is new credit, it affects your debt ratio. Do not make any large deposits into your account that cannot be documented. We're not saying don't make deposits. What we're saying is make sure that all your deposits can be documented. So don't make cash deposits, because we can't document cash. And then, of course, do not quit your job, because, of course, we need your income to qualify. So, keep those in mind. Those are important things from the standpoint of the processing department on what to keep track of. All right, information on myself. Again, should you have any questions, you can always reach out to me, and feel free to do so. Also, in the last webinar, I had mentioned, just as a passing idea, that it'd be interesting to put together a podcast of real estate professionals smoking cigars, where you can, on a weekly basis, just to have some more of a questions and answer, laid back atmosphere. And it was just an idea I was bouncing around. However, it's actually coming together. So certainly, if you are a podcast listener and curious about a variety of different things, each week we're going to talk with somebody different. Starting June 6th, you'll be able to find that podcast at your favorite podcast player. It's going to be, again, Real Estate Professionals Smoking Cigars. It's sort of cool, because it's a little pet project that I brought up 2 weeks ago, and now it's coming to fruition. So that's sort of exciting. Going on, also then, of course, the legal disclaimer that we're required to have on there. And then our next webinar, which I'm very excited about because it's going to be co-hosted, is going to be on Wednesday, and let me get the exact date here for you, June 12th. So on Wednesday, June 12th will be the next webinar, and that will be entitled Buying a Home with Little Money Down. The date on here is incorrect. It'll be on Wednesday, June 12th. If you go to the website, it'll show Wednesday, June 12th. Buying a house with little money down. We're going to be addressing, besides, of course, the down payment assistance programs that are available, we're going to be addressing other ways of purchasing a home where you can do it with little money down. It's very excited to be for this one because it is going to be co-hosted. So it'll be a first for trying something new here. We're having a different speaker. But certainly if you're interested, buying a home with little money down, you'll want to register for that one. Again, Wednesday, June, whatever I said, 12th. Yes, June 12th. And information will be going out on that. Okay. And then we've got a couple questions I see coming up here. So let's just take a quick look here. Mari asks, what if I co-sign for my daughter on a car loan? That's an excellent question. Because you co-signed, it's going to be on your credit report. So technically, even though you co-signed, you are obligated for that debt. Therefore, we'd have to count it against you. Now, if your daughter has been making payments on the debt for the last 12 months, and we can show that it's her checks or her account that it's being paid out of, we don't necessarily have to count that against you, as long as she's paying on time and it's being handled by her. But when you co-sign for somebody, it does affect your credit. We just had a situation where a dad co-signed for his son to buy a house. Son bought the house and everything was fine. Dad now wants to buy a house. Dad doesn't qualify for a mortgage anymore because son just bought the house, so we don't have a history showing that the son's making the mortgage payment. So when you co-sign, you have to be leery of that or be very careful of that because of the fact it does affect your ability to get a house. It affects your qualifying ability. So you definitely want to keep track of who you're sharing your credit with because it does come up. It could hurt you. All right, let's see what else we've got. Raymond asks, how does child support affect my qualifying? Okay. That question is an excellent question depending on which way we're looking. Child support does count against you because it's a monthly obligation, so you have to count it. Now, if you're referring to your receiving child support, well, that's income as long as the child is going to get the child support for the next 3 years, so that they're under the age of 15. If they're over the age of 15, even though they may go to college and everything else, we can't count the income. But if you're referring to it, counting it for the income, we can if you're receiving it. If you're paying it, we do have to count it against you. All right, and then Carl asks, I was told my debt ratio was in line by the bank, but they wouldn't do the loan. Can that happen? Okay, so I'm thinking I understand the question. There are many factors that go into underwriting a loan. Debt ratio is one of them. So you can, have good debt ratios and still not qualify. Your credit, there may be an issue with credit score, that score wasn't high enough, or, it's possible that you're trying to get a conventional loan and your debt ratio is above those guidelines. There's a lot of factors that go into it. Debt ratio is just one aspect of it. Just like previously we talked about credit scores being an aspect of it. Your down payment is an aspect of it. So it's just because, somebody comes back and says, yes, your ratios work, you could, have other issues in getting the loan. So yes, that certainly is a possibility that could come up. Okay, Jack asks a good question. If I buy a house for $100,000, but it's worth $120,000, can I use the $20,000 as my down payment? That'd be nice if you could, but no. We use the purchase price or the appraised value, whichever is less. So if you're buying it for $100,000 and it is worth $120,000, congratulations, you got built-in equity. That's a great deal for you. But we're going to base everything off the 100, so you'd have to bring in your down payment based off the 100. The same is true if you're buying it for 100 and only appraises for 90. If you really want to buy the house, we're going to base our loan off the 90. So you'd have to make up the difference or negotiate with the seller to lower the purchase price. Now, after a period of time, we can use the appraised value like in the case of a refinance. So you don't lose the equity. The equity is yours, but it's not lendable equity initially. We have to base it off the purchase price. So hopefully that answers those questions for you. Again, if you have any other questions, certainly feel free to reach out to me at any time. I'd be happy to answer any questions you may have. Again, if you listen to podcasts, certainly as of June 6th, please download our podcast and let us know what you think of it. Again, it's Real Estate Professionals Smoking Cigars. And finally, a reminder that our next webinar will be it's going to be a very good webinar, special one, buying a home with little money down, again, Wednesday, June 12th at 7:30 p.m. And if anyone else has no questions, again, thank you for tuning in. I appreciate any response you may have, good or bad, so we can improve on our webinars. And then until next time, we will, again, give me a call. Thanks.